So for those of you who are joining, hopefully you're already following the City Press Money Makeover Challenge. We do this every year where we take we take 6 people through a money boot camp with ABSA, and each of them have been paired with their own financial advisor. And one of the big things that we always have with Money Makeover is debt and credit. And it's probably the first engagement that you're ever going to have in your financial services is going to be around credit and debt and those sorts of issues. So we thought it would be a really good Facebook Live event to hold where we're going to chat to 2 experts from ABSA. So I'm going to introduce you to them. These are the guys who make decisions about whether or not they're going to lend you money. So we have Ashwin Jagmohan he's the regional manager of credit lending. And then we've got Nick Nkosi, he's on from the retail bank side. And both of these guys, I must tell you, have been very involved right from day one of Money Makeover. And they help select the candidates. So they know all of our candidates very well. They know their credit scores. They know what they have to do to get right. So welcome, guys. And thank you so much for the time today. I just want to kick off with my first question, which I think is the burning question for many people who are wanting to borrow money, whether they're looking for a personal loan, whether they're looking for a home loan, tell me about this credit score. What is this credit score? How important is it? And maybe even more importantly, how important is it to the bank? Maybe Nick, you want to kick off.
Yeah, thank you. Thanks, Maria, and good evening to everybody. Yeah, as banks, there's a couple of things we look at. The first one is around one's willingness to pay back. If you want to borrow money, you want to buy a house or a car, are you willing to pay that back? The second thing we look at is the ability to be able to pay it back. And what I mean about these 2 terms, ability and willingness, ability is like, yes, I can afford to pay an installment of X amount of money every month. So the ability is there to be able to repay my obligations or my debt. When it comes to the other one, in terms of the willingness, this is really where, Maria, then we start looking at your history. How have you performed previously? You had an Edgar store, you had a Wooders card, or whatever it is, where you are obligated to repay it on a monthly basis. So we look at those things in terms of your history to say, how have you been able to manage your obligations, first and foremost. So, because when you come and apply to us, that's one of the first things we look at. To say, okay, Ashwin's got a car, a vehicle and asset finance car already financed. So we're going to look at his repayment history. How well has he repaid over the years in terms of the obligations that he's got with the bank? So that's the first thing we really, really worry about. Is okay, from the credit bureau, we can see that you've missed a few installments, which doesn't necessarily disqualify you. But it's very different from somebody who's never missed their commitments already. That differentiates the risk of the people that we're dealing with from the willingness portion of it to pay us back. So we look at how well you conduct your accounts where you already have debt. How well do you pay it back? And also, doesn't necessarily mean that, there might be instances where you might have missed a repayment, but as long as there's an arrangement that was made with your bank. So we'll look at all of those things and say, did you do that? Did you not do that at all? So those are really, in a nutshell, when we talk about the importance of your credit score. In a nutshell, Maya, I would say it speaks to how well you keep to your obligations, where you borrowed money somewhere else and any of those things, in terms of just keeping up with all the repayments.
So your credit, I like what you said there. There's 2 parts to credit. One is your affordability, and the other is your propensity to repay. So there are some people who will do anything to repay their debts. And there are other people, they're like, this month I've got other expenses, not so much. And that's actually what the credit score is telling a bank who perhaps has never engaged with you before. And they're like, is this somebody who thinks repaying their debt is important? And I think that's really, really an important point. But Ashwin, I want to bring you in here because what surprised me quite a bit, and I have to be honest, when we got this year's Money Makeover candidates, we have to get their credit scores. It's one of the things to see how much their credit scores changed. Some of them had applied for the Money Makeover because they felt that they weren't managing with their credit. They had too much debt, yet their credit scores actually weren't that bad. And it does feel to me, Ashwin, a little bit like people with a lot more credit tend to have better credit scores.
Yeah, and I guess we're going to get that, I mean, we've got major players in the industry that calculate credit scores differently also, especially between our different bureaus. So that's the one element in terms of how the scores are calculated. The second element is around the exposure of that client of ours. So the credit score could have been great, but if we looked at the overall exposure between their secured debt or unsecured debt, that might have put a hamper in that application, because when we looked at their overall affordability, and we're quite regulated from a National Credit Act perspective, whereby affordability is one of the main categories in which we approve facilities. So we could have said, yes, you've been brilliant in terms of your score being good, based on what Nick has said, based on looking at other components. But if the exposure was high, and that's just one element, of a credit score, we could have said your exposure or your debt to income ratio might have been too high. And that's why we could have declined you.
Mm.
Mm.
And is there any like red flag for either of you that somebody comes in and you just say, no, this is just like straight up no?
Yeah.
There's a few, Maria, and again, a lot of these are kind of like self-inflicted in a way. For example, if somebody is already under debt review, that's an immediate no, because by entering that formal process, you're basically saying, I am not able to manage my finances at this moment. That's why I need help. So we can't be seen to do anything to put you in a worse off position. Somebody who's sequestrated, for example, already, somebody who's just going to say, in the past, I've never managed my debt, etc. Those are some of just the automatic things that would disqualify anybody. The debt and all of those things, there might be exceptions where we would look at it. It's not an automatic disqualifications, but certainly by entering some of those processes, that means you are protected under the law. We cannot give you more credit because you've told us that you need help to manage what you currently have. So it would be very reckless and irresponsible of us to continue to give you more. Those are just some of the immediate examples I can think of, Ashwin.
Yeah, I mean, we could look at judgments and defaults, and we could also look at them from an age perspective and say, but how old is this judgment, or how old is this default? Because at some point in some clients' life, they would go through a difficult period. But I mean, the regulations have also changed in terms of looking at those things differently. Age could be a factor. Customers who are often, not earning a full-time salary. Customers who are earning differently in terms of commission or other income that they might be receiving that's not consistent. So those are some of the elements, upfront we can review and say, you don't qualify based on these components.
And if I may add one more, Mario, it's also around, obviously, affordability. It's the most obvious one also, right? You might say, I need 100,000, but the reality might be in terms of when we do the assessment, the affordability assessment, looking at your current expenses, how much you've got, we might say based on all of these things, you can only qualify maybe for 10,000, not 100,000 you're looking for. So it's not a complete no, it's just a disqualification from what you originally wanted.
And Nick, I think that's such an important point you raise, because I see people getting very angry when that happens. They say, but I need more. And I don't know if people understand the extent to which they're just digging a deeper hole. That actually sometimes when a bank says, you can't afford this, that is actually a really, really good thing. that you must listen and say, okay, this is not a solution. Taking on more debt that I can't already afford to repay is really, really not a good thing. So I get two complaints about banks. One is that they lend too much money and they get everyone into debt. And the other is that they don't lend anyone money when they need it. That seems to be the two complaints I get all the time.
It's the whole insurance umbrella thing. When it's raining, we take away the umbrella, and then
exactly.
But to that point, Maya, how we look at affordability, like I said earlier on, it's really we look at Maya's income and expenditure. What I mean simply, you've got a salary coming in that's 5,000 Rand, as an example. We'll look at your expenses. How many expenses have you got? You've got a car already, which means you have to pay so much back. You've got school fees. You have transport. You've got you have to leave also, right, in terms of food and groceries. So we look at it holistically. And also you might say your expenses say you only have 200 Rand. But we know also from a regulation point of view, there are certain rules we have to follow to say no. Typically, somebody who earns 5,000 Rand, their expenses have to be like 500 as an example. So we'll take that. And that's part of the National Credit Act to say we have to really look at the expenses, because sometimes people understate the expenses because I want the loan. But we really have to factor all of these things in. We also have to worry about, okay, can you really continue to afford this loan in the event of interest rates going up, for example? Because we don't always think about that, because we hope for the best. That tends to become our strategy. So those are all the kind of things that we look at. But it's not just that. We could also help you to look at, well, maybe if you combine this debt and this debt, it could free up affordability. So it's not just about us saying no. We look at other ways of how we can help you to make it work, but it has to work on a sustainable basis so that we don't put you in a bad position. We don't want to be seen as giving people too much credit when they when they really cannot afford it at all, which is what we call reckless lending from our side.
Absolutely. Now I want to jump back to the credit score question, because I want to get a little bit just now. I want to cover what to do when you're struggling to make repayments and things like debt consolidation and debt restructuring. But I see Tendai's asked a question about credit scores, and I think this is a very important question, Tendai, because I've noticed this as well. Why does my credit score differ from TransUnion, Experian, etc.? And I was just telling you, my husband's involved in a business where they look at credit scores, and he said they can be completely different, and sometimes judgments are picked up by one credit bureau, then another. What is behind that, and how do you, as a lender, do you look at all of them? Do you want to take that one?
Yeah. I think. Yeah.
Oh, Ashwin, you're going to go.
Yeah. So, I made the point earlier to say, different credit bureaus have a different strategy in terms of how they calculate a bureau score. Now, as an example, within our credit card environment, we will use, for example, TransUnion. And TransUnion, for example, takes a base of all their customers that's currently listed on TransUnion. And based on that and based on their strategies, they will derive a credit score. So the credit scores won't necessarily be a vast difference between the two. Okay, it's just a matter of how it's being reported also on the bureaus. Remember, certain service providers report to the bureau a day later, or some might be a month later. It's just at that given point in time, the score might have been lower. But I think with the credit scores, it's also good for our clients, to constantly engage the bureaus to check what their score is like. And there's also tabs that say, what do I need to do to up my score? What can I do to improve it? What are some of the things that might not necessarily be mine? There's also incorrect reporting that might happen. And these are some of the things that could contribute to that low score.
Ashwin, I think it's a very important point you make. Your credit score is very important. You should spend time. And here says Maya pointing her finger, and I've just realized I haven't looked at my credit score for a while, but I'm not borrowing money, but still I should go look at it, because it's a great place to see if you've been a victim of identity theft, for example, and things like that. So really, really important. And I want to, Nick, ask you as well. We've got both. We've got two of our candidates. Milibakazi and Malefi are looking to buy a home. So we've actually got two of them who are really trying now to get their credit scores ready for home ownership. So first of all, how do you improve your credit score? And I see Elsie asks a very good question. She says, I defaulted on my monthly payment. However, I managed to pay it off. Can it affect my credit profile? The debt was paid within the time frame. So what are the kind of things that maybe somebody who is trying to get their credit record ready to buy a home should do? And the other big bugbear I want you guys to answer is, so Malefi is actually He's saving, he's investing, but he's got no credit. He shut down his credit card, doesn't borrow. How does he really have to go and get a credit card for you guys to lend to him?
Wow, Maya, see, you're not holding back on all this. Questions.
I'm a champion of the consumer here.
So, Maya, good question. I think that the first question around, somebody who's been paying inconsistently, but they've paid it off. That now on the bureau, it will show that you're inconsistent payer. That's really an important thing. You've paid it off, but we will see, like I said, the willingness, you've paid it inconsistently, etc. There might be some very good reasons for that as well, which then your lender would ask you like, okay, but we see we had some few problems here. So that's one of the key things that you really need to look at. You raised another important thing. Sometimes we pay off our debt and we forget about it, and rightfully so, because we celebrate and move on with our lives. But sometimes you might find that whoever you borrowed from still has it showing on the bureau, meaning they haven't updated your record, and we don't know that until you go and want more money for something else.
Yes.
And to the point you made earlier on, Maya, about the importance of just checking your report. All the bureaus give it to everybody free once a year. So you really have an opportunity just to make sure that it's up to date. It reflects the latest things. Absolutely. That's really, so inconsistent payer, it will show, but the fact that you paid it off, if you paid it off on time, that's really well done to you. That will be taken into consideration. Now, if somebody wants to buy a home loan, or what are some of the things that they need to consider? I think, once again, like you said, if you have debt, and I will come back to the one with nobody without credit, with credit, make sure you pay it consistently. But I think also sometimes you don't often think about the complete cost of home ownership. And this really speaks to affordability. What do I mean by that? Obviously, there's the bond registration costs. Depending on the amount, there's the transfer costs as well involved already so all of those things you need to take into account. There's ongoing rates and taxes as part of just your ongoing running expenses. So I would say as a starting point, Maya, just for somebody just to do some really good, almost like background also, and check in terms of the rates and taxes, what is your municipality saying? How much is it? Because they get reevaluated every 5 years. So sometimes they might double. So they will never go down, that I can assure you. So they will always go up. So those are just some of the important things. Obviously, right now, also, if there's no electricity, how do you start thinking about alternative energy, etc.? Those are all the things that I encourage people to really think about. So, okay, can you afford that as well? Electricity is going to continue going up as well. Now, it doesn't mean that people shouldn't buy a house. I'm just saying, just don't think about affordability today. What happens if the interest rates go up also, because the size of a home loan versus a personal loan is very different. And also you start feeling it financially the moment your home loan goes up. So it's all of those things that one just needs to consider over and above with what we've said about making sure your credit record, you continue to pay your repayments consistently, you pay what you owe. But also in the event that you don't, life sometimes happens beyond our control. It's important that you go and speak to your bank or whichever the institution that you bank with, and they will make an arrangement where possible.
Yeah.
I want to talk a little bit now about the arrangements, but Ashwin, you want to make a point?
Yeah. No, I was just going to add to what Nick is saying. There's that additional cost. If you look at it, Nick's mentioned a few. There's also the insurance. That's a big factor in terms of when you bond a property. So there's that insurance element, and there's also the maintenance element of owning your own property. And those are all key things that contribute on a monthly basis. So as much as we say, yes, we can afford the bond repayment, but our customers need to take note of all the additional expenses that come along with it.
But I'm going to pin you down here, Ashwin, on that question about, and I also want to get back, we're getting more questions about credit scores, which I want to get back to, but I want to pin you down on Molefe's question, which is, do I have to go and take a credit card out now in order to create a credit record to get a home loan? When I'm sitting with a lot of investments, I'm sitting with disposable income. How would the bank view him?
Yeah. So if I look at, let's just talk about investments. Okay. I mean, if Molefe has investments already, that's an excellent indicator for us to say Molefe actually has a surplus monthly income of which he's currently putting away. And that's brilliant because it shows that, one, he's got a lot of extra money. So if he has to take out debt, the repayment ability potentially is there. And then secondly, having credit is also not a bad thing. So if, for example, Molefe does take out a credit card, now within the bank, we apply different strategies to different customers based on, yes, their credit score. Now, having zero products on the credit bureau will potentially give him a low credit score. because the bank and the credit score, the credit bureaus are uncertain about how we'll be able to repay. We can't see what his exposure is. We can't see what his timelines are to repay. We can't see, for example, how he's utilizing the product. So having that one facility will be great, and it's a good starter for Molefe because now he's starting to build up a bit of history. So irrespective of the limit, that's already a starter for him. Molefe could take out 2 products. Taking out 2 products will give the bank a much better indication of how he's then paying. And these two products can be anything. It doesn't necessarily have to be a credit card. So any service provider that reports it on the bureau. So he could take out a cell phone contract. And that cell phone contract is reported on the bureau. And as it is that cell phone contract, if he pays it monthly via debit order, which is mostly encouraged, then that's already showing the bank that he has the ability to repay. He could take out a retail account, whether it's be, for example, any of the other big chain stores, for an example, whether he's buying clothing or groceries or food or whatever the case might be. That in itself is already showing the bank his ability to repay, in that irrespective of the amount he owes or the balance, he is paying it back timelessly. He is paying the amount that's due. And that in itself is going to show us that he has the ability to repay. So it doesn't necessarily mean he must take out a credit card. It's any product that's going to give us that history.
And also, if I may add, Maya, to what Ashwin says, having a cell phone contract is also important, because once again, that's a contractual obligation which you have to pay on a monthly basis. It also shows us that you can repay. I also wanted just to say, banks have advanced quite a lot now also. We do acknowledge that not everybody wants to be in debt. That's when we talk about people with a thin credit score. Because having a thin credit score is not necessarily always a bad thing also. It just means somebody steered out of debt. So yes, the score, to Ashwin's point, is going to be lower, but we'll treat that person very differently from somebody who's got a very low score because of how they've behaved. They've behaved in the past. So I certainly don't want Molefe going out there and getting all kinds of debt because, this is what the bank is saying he must do to get credit. No, certainly not.
Yeah. And I always think the advice I generally get when somebody asks me this question, I say, you know what, if it's going to help your credit score, take out a credit card with a limit of 1,000 Rand a month. Use that 1,000 Rand and pay it in full. It's showing a repayment pattern. You don't have to go and, even if you qualify for a 40,000 Rand credit card, you don't have to take it. It may be tempting. In fact, really don't take it. That would be my advice. I'm going against what Ashwin wants to do because don't mind, stop telling people not to take credit. But I've had some more questions around, and I think this is very important because Tulani and Tendai's questions are actually quite similar. Tulani's asking, does a payment holiday affect the credit score? And remember, Tendai was saying, well, I was hit during COVID. I couldn't pay. And, obviously a lot of those payment holidays were given during COVID. Yeah. Tendai is saying, I did fall behind, but now I'm paid up. How long before my credit score improves? Are you going to apply some leniency? How are you viewing that? That real experience of COVID and those payment holidays, and just generally some people unable to pay back.
Okay, Nick? I'll go first. Yeah, I think there's a whole payment holiday, right, which is a process that works all the time. But Maria, what it means maybe to Tulani is you can't give yourself a payment holiday as long as it's sanctioned by the.
I love that. Sorry, I have to pause for a moment. You cannot give yourself a payment holiday. It has to be something the bank agrees to.
Exactly, that's important. And as much as we all like to give ourselves that, no, it doesn't work like that. So if it's part of your contract, as part of an agreement with the bank, it does not affect your credit profile at all. Right. And then, Maria, to your point, we've got a lot of customers who, during these horrible times we've just gone through, COVID, lost their jobs, their salaries were reduced, and a lot of other things that happened, right? I guess, hopefully a lot of the people also took advantage of what the banks offered at that time, because there was a lot of payment relief that we came out with. As Absa, for example, I think there were over 20 billion rands worth of payment relief we made during that time, just to help people to say, okay, you can only pay a third of what you need to pay. That's fine. You need to pay it for the next 6 months. And then after that, we started upping it. Now, that's a formally sanctioned arrangement. That is fine, as long as one still kept to those installments that had been agreed to. So that wouldn't really also affect anybody's record. But as long as then, like I said, we said maybe for 6 months, you need to continue paying X amount, but you needed to stick to that arrangement. That's the important thing. If you didn't, it pretty much becomes part of a default, like you did not keep to your promises around that as well.
And Ashwin, maybe to ask you that question. So if somebody did default, but they have not paid off their debts, they went through a bad patch, how long before their credit records rehabilitated? How long does it generally take for that credit score to start picking up again? Or what could Tendai do right now to kind of help improve his credit score?
Yeah. So I think I mentioned it earlier to say, the scores are differently calculated by the bureau. So it could mean an instance, and generally within the bank, we look at a period of 3 months. So we look at a period of 3 months to say, over the 3-month period, has there been improvement in that the customer has kept through, his contractual obligations? So has he started to make the payments that was due? Is he now paying on time? So when it comes to trust, we'll consider that. We'll say yes, and I think I mentioned earlier, say, there is a default period sometime, or you could have paid it late, and so we would consider it. We would look at those sort of things very, very differently, should Tendai apply for a facility.
Okay. So I think it sounds to me like it is about, you will look and consider things. And I think you must try and motivate if you feel there was something going on there as well. So I want to get to another sort of section. So we've spoken a lot about the credit scores, but for so many people, and I mean, Nick, you alluded to it, we are seeing such a lot of issues around people defaulting now, and with home loans, and it is home loans. I feel these interest rates have really, really hurt people. I mean, on a R1 million home loan, you're paying now 3,000 Rand more than you were before the credit credit rates increased. And I know one of the banks came out and said they had a substantial number of customers whose mortgage repayments were now reaching 40% of their salary, just their mortgage repayments alone. So if you are struggling, if you're saying, look, I'm struggling, how do you, what is your first step?
Yeah, Maria, and this is such an important question, not just, on the home loan front, in any situation, whenever a customer is struggling. The only advice I can give everybody is just talk to your bank. That is really, because ignoring the calls and running away is not going to resolve the situation at all. But I would actually encourage people to say, before you even get to that position, if you can foresee that you're going to have a problem, how do you start having that conversation with your bank? Because to the point you've made, Maria, there's a couple of options that we can look at just to help the customer through this difficult period. Because we do realize that, most people don't skip their payments by choice. Certain things happen, others do, but the majority of people don't. Life happens, and then there's certain things. So the one advice, really, I cannot overemphasize this. It's just speak to your bank and be honest and say, I've got a problem. They will look at what are some of the best options for you. For example, some of the options might be, they might say, okay, maybe you can continue to pay this amount of money for X amount of time. That's one option. They might say, we're going to look at how best we can maybe extend the term of your loan so that we free up some affordability by doing that, so that you can pay less. We can look at how do we restructure your account, etc. So there's always options that we can look at. But those options tend to work when you've always kept to your arrangements also. Right, because we can see that this is a unique situation. It's not just Nick, has decided to skip his bond and went on holiday instead. But we can see that no, this person had been a consistent payer all the time.
And Nick, I think what you just said is so important. You know how many people come to me and they say, I'm stuck, I don't know what to do. And I say, well, go speak to your bank and see if they can restructure. They come back, say, no, the bank's refused. And I always think that's a bit weird. And obviously, because I know you guys have back channels, I follow up. I say, but guys, you always tell me to tell people this. And you know what? They've defaulted before. Every single time. It's so when a bank turns someone down, what I've realized is that they already had restructured the debt and the person hadn't stuck to the new agreement. And once you've done that, it's very unlikely the bank's going to come to the party the second time. Am I right?
And it boils down to what I was saying earlier on, Maya, around the willingness. You had a debt, you had to pay $100. That was an agreement between the two parties, but then you don't pay it. That's really, and again, whether we make a restructure to say, but we've been here before, we don't believe that you actually going to keep to this commitment again. We can restructure it, but the chances based on your history tell us a very different story altogether.
Ashwin, I see you want to make a comment.
No, I was just going to say, right to Nick's point, the simplest form is don't wait for it to get too late. Don't get to that stage where you're already, battling to start making repayments. The first instance of saying, I cannot afford it, or you can foresee that you cannot afford it, and keeping up with the, sort of macro environment gives us an indication to say, rates are possibly going to go up. And that already should spark something to say, R1 million bond, you just mentioned over the last year's 3,000 Rand increase. Now you're getting 0.5% interest rate hike. That's already going to set you back in your affordability. So immediately contact the bank and say, I'm foreseeing it. I can foresee I'm going to have difficulties this month or the next month. And what can we do to try and help you?
And I want to look at a little bit of I'm going to hope if I can share a screen, because I want to show, just also let our viewers just be aware of the implications of extending debt, because it does have implications. So this is not something you should do just because you just want some relief. It's something you should really do as a last resort. But Thulani's come back with another point saying that he got a 1 month payment holiday. The vehicle loan interest rate was fixed, but immediately after the payment holiday arrangement, it's been increased. So I'm assuming he's saying the interest has been increased. Should I view this as normal? Now, it's possible. I think I'll definitely go back and check with the bank, but it's also, remember, your repayments may be increased because you've got to make back the 1 month. How would that not, does that, Nick, maybe, or Ashwin, do you have some sense of what may have happened there?
Yeah. So, I can't speak for vehicle finance directly, but I think, for Thulani's starting point should go back to vehicle finance and just understand whether during the skip month, they had hampered his interest on that facility or for that month, or did they put a stop on his interest and the capital? And how did they then calculate it after the period? Because he could have then calculated the capital and interest or that installment for the month over the remaining term, or they could have increased the term as well. So it just depends on the arrangement that he had made with the bank at that time.
Okay, so I think always things with these sort of things, it's best to go and speak to the bank directly and ask that question. But I want to just see if I can show my share screen. I'm just going to see if this will work. So I'm not sure if it will. I'm on a different platform today, so I'm not sure if it will be, but let's see if this does show. Here we go. So hopefully you are seeing this. Do I take a new home loan offer? Can you see that? That should be coming up, I think, hopefully.
Yes.
Yeah. So this was very interesting. I actually did this maths because I had someone asking me this question. So, you have an existing personal loan of, let me do it like this here. Can you still see it?
Yes.
Yeah. So I had someone asking, do I take the new home loan offer? So I have an existing personal loan of 65,000 Rand, 24% interest, installment 4,500 Rand. There are 22 months left on the loan. Now I'm struggling to repay it. So the bank says, you know what, let's do a debt consolidation. We will take out a new loan at 21%, so you're even getting a better interest rate, but we're going to extend it over 58 months. And the installment drops to 2,500 Rand. Now, somebody's going to, I think a lot of people, they think, oh, that's because of the lower interest rate. I'm now going to pay 2.5 instead of 4.5. This is great. It's giving me a little bit of leeway. I can breathe. But actually, if you have a look at what that's costing you over the period, the current loan, so if you stuck to the 4,500 and paid it off over 22 months, would cost you 99,000. That's how much you would still pay off. So your 65,000 Rand loan would be 99,000. But with the new loan, paying it over 58 months means you would actually land up paying 145,000 Rand for that loan. And I think that's, it's very important for people to understand that the minute they lengthen the term of a loan, yes, there is a degree where you will now be, your premium comes down. So we're all happy because our premiums have come down. But I don't think people really, really understand total costs. I mean, do you think it's important for a bank when you're structuring or looking at these options that you really talk to people and explain to them the consequences and that they understand the longer term consequences of restructuring?
No, absolutely, Maya. That's one of the critical things because, like Thulani's example, for example, in terms of like how did it change the fixed rate, etc. It's important to understand all the terms to say, what does this mean exactly? To your point, it might mean, and that solution might work for somebody, by the way. But to your point, Mari, as long as they really understand the total cost of credit. Because I might say, I just need some space to breathe for the next 6 months. That's why I need a lower installment. And also, you don't have to pay it off over that period of you can repay it shorter than that. So it could work as long as one is intentional about what it means. But it means it has to be explained to you to say, you had only 22 months left. Yes, you were paying a lot more, but now you're going to be taking it over 58 months with more interest, etc. But it's really important, and also it's important for the viewers and the audience to ask questions. Even if somebody has explained it to you, if you still don't get it, ask again, and just ask them to say, okay, tell it to me in English, not in banker speak. What does this really mean also?
Absolutely, yeah. And also just so important with the with just when you're extending a loan, understanding the issues. I want to just, before we end off, if there are any more questions, people can just pop them through. But I wanted to end off with a question around debt consolidation, debt review, because we did this year, we did something very unusual with Johan. We actually went for, and Nick knows, he's nodding his head, because when Nick saw Johan's debt exposure, he was like, yo. And sometimes you just cannot solve for it. We said we cannot, we can't solve his debt problems simply through a consolidation loan. He had to consider debt review. So maybe take us through what point do you think somebody, when should you consider debt review, and why did you think it was okay for Johan?
Yeah, so I think I'll kick us off with the debt consolidation, right? So, I mean, with the debt consolidation, we look at the unsecured debt that the customer might have throughout the various institutions. And we could look at taking into consideration whether it's a credit card or an overdraft or or a personal loan. I think what's important for us is firstly to understand the exposure this customer has. So within the different banks, each of our products have different, product limits. Now, if the exposure is too high, that for one is an indication that he might not meet any of our product limits or meet the expectations of that facility. The second thing is that if we are to consolidate his debt, now when we consolidate his debt, we take into consideration that this customer, and Johan in this example, might have been paying for different facilities at different interest rates and different terms. So if we had to then say, okay, how do we offer Johan a 350,000 facility over 84 months at X interest rate? But is Johan's debt 350,000 or is it 700,000? So that's the one element. The second element is we need to look at the debt that Johan currently has. What is his payment history of that debt? So does he have facilities that are currently in arrears? Does he have any judgments that's already listed on him? So do we look at the defaults? So that's the other element that we would consider to say, okay, we're comfortable from perhaps a risk element, whereby we're saying, okay, his exposure is in line, and his risk elements are in line, we might be comfortable to take on that debt. But if there's certain red flags, should I say, then we're going to say, okay, we're not comfortable based on 1, 2, 3, and Johan's next best option would be debt review. Now, debt review is then housed by an independent body. And what they will do is they will go back to each of those service providers and say, okay, Johan's got 10 facilities, for an example. We know they're in arrears. There's already a judgment or a default that's been listed for him. And that independent body or the debt review team will go back and say, okay, how do we now put these accounts on hold? How do we look at consolidating all Johan's debt into one body, mitigating all the risks that there might be? However, going on to debt review means that Johan, for that period, would not be able to take out any further debt. He would need to be on the program till his debt has been cleared via the various institutions, and then only would he be debt-free. Versus a debt consolidation, after we've consolidated that loan, there's no guarantee that Johan could not go on the same footing. There's no guarantee that Johan can't go the next day to another institution and apply for his facility. So debt consolidation is great if you're looking at short-term debt, we're looking at the exposure, the value. But if it's a lot bigger and we can see the client is really, really in a jam, should I say, whereby the exposure is very high, he's already gone to that stage of being in arrears, then debt review would be the next best option.
And yeah, and I think it is the point that and that was the thing that made Johan so nervous, was the fact that he could not access any more credit for the next 5 years, which is the payment. But I mean, the debt review has been very successful. He's managed to negotiate much better rates, or his debt counselor has, and it's positive. But he had to. It was very hard for him to say, well, what if I have an emergency? What if I need it? And we had to build up an emergency fund. We had to make sure that he's got some cash flow in case of an emergency. But it was a dramatic step, but I think a very good one. And I know, Nick, I think you're happy that he's taken some action.
No, I'm very happy. And also, Maya, to your point, Johan's case was really, he really liked taking debt. I don't know how else to put it. But also what he had against him also was age-wise. Remember, because that was one of the critical things to say. But obviously, I mean, I can say these things because nobody knows Johan we're talking about. So there's no client confidentiality, anything issue that we are not adhering to. But the concern was really that he had a few years to go before retirement. So this was really about how do we help him to retire without this debt, which meant that he had to go on an extreme diet, in this case being the debt review as opposed to debt consolidation, so that he's not tempted to take on more debt.
And I think it has been actually very life-changing for him. And I think what I see, Nick and Ashwin with Money Makeover is that when people commit to this process, they commit 100%. They are in it, they do it, and we see phenomenal change in just 6 months. So I want to say thank you to both of you for being part of this journey. And for sharing, knowledge with us, and for helping me select the candidates. so they've been through this from the beginning with me, and are very aware of it. And I hope everyone listening has found this useful. We have certainly been answering your questions, but please, you're more than welcome to post questions and post this video, and we'll make sure we get back to you. But thank you once again, Ashwin and Nick, for your time and for helping us understand a little bit more about credit and the pros, cons, and especially your credit score. So thank you.
No, thank you very much, Maria. It's been a pleasure.
Thanks, Samia. It's been a pleasure. Thank you, Maya.